Yep. Okay. Good morning, everyone. Thank you very much for coming along. Welcome back to ARBE 4310, Construction Business. Strategy and Finance. A couple of things that I would like to inform you before we start this series of lecture about finance. The first assignment, case study 1, is now being marked and nearly complete for everyone who submitted on time. For anyone who got some extension and submitted, already got the extension granted and submitted already, give me a little bit more time to go through all those lists. And also for our Singapore BCA cohort, because your semester started 2 weeks after Australian classes, so I think many of you probably already submitted your case study 1. So your BCA mark and comment will be marked and released slightly after the Australian group. I have looked quickly in a number of assignment that has been submitted in the case study 1. I think overall view, I think everyone pretty much get the gist of what the assignment has asked you to do. So, however, when you read some story, when you read the case like this, which is a real world business in construction industry, what will differentiate between past and HD? How can you see the detail in those story? Right. During this marking period, I and marker have listed a number of issues that actually happen in the case. Apart from everyone getting your own individual feedback, which has been put in your Turnitin submission, when the mark release, you will get the mark, and when you access the Turnitin, you will see your individual feedback in there. But I will be discussing overall feedback of the case study 1 probably before at the beginning of week 8 when we resume from the break. So then you have time to make some adjustment for your case study 2. And along the way of this week 7 lecture, I will be talking about assignment case study 2 as well. All right, let's get into it. This week 7, 8, and 9, these 3 weeks are the series of the content about financial management. It is quite complicated area of study, and please take these 3 weeks as a kind of introduction to the real complicated world, real complicated side of construction business when we're talking about money. As you probably can see as well, that we even have undergrad degree and master degree just purely for finance and finance alone, and also separate degree for accounting. So the area topic is so big and it's so complicated. What I provide for you is I try to grab the thing, the context, and the knowledge itself that you need to be aware and you need to know about finance in construction industry. At the end of the day, you are CM, you are construction manager, and one day you will become company manager, and one day you might become your company's founder. When it comes to this side, the money side of the business, you definitely going to need a professional help from either finance advisor, and definitely you're going to need accountant when you run your own company. But from now till then, let's have a look at what are the things that you will be seeing, hearing when you get into the job, even as a construction manager, right? These are 3-week series because the topic is quite big. So it's a continuous topic. And you will be needing this 3 weeks content when you look at case study number 2. So in Managing Finance 1, this week we're going to cover the content about construction firm ownership and structure, finance management introduction, and of course in finance management there are so many terms. Finance and accounting, even though they are a kind of separate subject area, but for this purpose of this course, I'll try to kind of combine it together. You have to understand the common terms that people in finance and in accounting use when it comes to the term that you need to manage your own company or even manage your projects. And some of those terms come with some what we call document that you need to be able to read and understand it. And those are balance sheet, income statement sheet, and cash flow statement. These are the 3 things that you will be seeing in almost every construction project. You, as a construction manager, you might not need to do those documents yourself, but your day-to-day job on site, all of the documentation that you're doing on your role managing on-site construction will feed into these 3 things: balance sheet, income statement, and cash flow statement. Let's start with, this is just to repeat the information that actually it is the fact, is true, and it's hard to accept. The CEO of AIB mentioned in his editorial piece in 2018, he mentioned that in overall business insolvencies in Australia, right, 1/5 and between 1/5 to 1/4, we're talking about 20 to 25% of all of the business in Australia that gone bankrupt, unoperable. 20 to 25% are from construction industry. So that's quite a big problem that actually is in our face. This fact, I see it in a way that this is not kind of blaming, but this is the fact that all of us who work in the construction industry should know and be aware of. Even though some of you working in the industry and are not manager yet and not have your own company yet, but eventually later on in your career path, you will get up in a higher level in the organization hierarchy. You supposed to be ready and have certain level of knowledge about how to manage money in either project level or company level. So that's why we put together this course to give you some level of introduction. And of course, because this is just only one course, 12 weeks, right? It is just the beginning. It's just the introduction. Later on, you're going to need to seek a lot more additional knowledge when you get to the point that you need to manage projects in a higher level or the company. So the statistic is quite scary. 20 to 25%, that's a lot. It's showing that we are actually not very good at managing money. Having said that, it's totally understandable because we have been trained, right? We have been trained to do a specific job, which is to construct the building, to build the building. We haven't been trained to manage money. We are not accounting and we are not finance advisor. So that's why we need to tap into this area of this subject area a little bit more to be able to understand the whole things on how things works in the business world. But before that, as a construction business and company, right? And company, regardless to size and structure, the duty of the business is to somehow manage its own finance, manage its own work that they committed to their client. However, there are a number of types of that business entity that we need to understand because different type of business entity or ownership structure has different way of operating, has different way of reporting and managing investment, ownership, and profit. So in general speaking, in construction projects, there are so many stakeholders involved. For example, like general contractors or builders, subcontractors, suppliers, upstream to consultant, architect, engineer, up even further to project owners. It can be individual or company entity who you're working with in construction project. So let's have a look a little bit how many type of these ownership structures that we have or commonly used in Australian context. The type of business ownership has an effect on how you operate the business in form of decision making, responsibility, profit taking. If you take profit, you also need to take debt as well, and above all, tax, because you existed as a business entity. You need to pay tax to the government, right? So the first example of ownership is sole proprietorship. This is very popular because it's easy to manage. It's kind of single voice, single owner. But when I say so, this could be a family business that you run with your mom and dad or uncle, but the whole unit of you count it as one. So your family unit manage the whole thing. So when you make a decision, it's just only the matter of you discuss it within the small group of yours. And it also can be one single person. which make the decision-making process a lot easier than bigger or more complicated type of organization structure, right? This sole proprietorship is normally the owner who's entitled to everything that's belong to the company. When I said everything, is including profit and also the debt that you owe other people. The second ownership structure is partnership. Partnership is normally happen in the business where two or more individuals come together and form up a company, right? And two or more people, everyone contribute. All of the partners who come to join this particular company has to contribute to the company. It could be in the form of cash asset, or in our industry, construction industry, equipment. And the profit, if the company is successfully run, the profit are passed 100% to the partner and are taxed with other personal gain as well. So when I said 100% to the partner, let's say I and my friend, two people, decide to come together and join this partnership to form up the company. And in the agreement, when we form up, we said all the profit will be split 50-50, which means when the company operated, if we get income and after deducted tax, those net profit will be divided into two, 50% for me, 50% for my friend. These are partnership, which is different to the first one, which is sole proprietorship. Now this partnership is kind of, when you join it together to form up the company, is there for long haul. This partnership will keep remaining all the business life of that company. Doesn't matter how long that company will last. If the company successfully run and make profit every year, so that partnership will stay with the company as long as the company exists. Now, because construction company is quite complicated, there are so many type and application of buildings and projects that we build, that leads us to the other type of firm ownership structure. The third type is joint ventures. These usually are the business entity, right? Business entity that come together, resemble a general partnership. It is not individual and individual, because if it is individual and individual, it will become partnership. This is for companies to come and join to form up a partnership to carry out specific tasks, to carry out specific project. And when the project finish, the joint venture finish, everyone split up, go back to your own world. This joint venture, why it is become a common practice? Because in many cases, in many construction projects, where the capital investment of the project is, the value is so high, value is so large, sometimes one company can't handle that large capital investment. That's why that's why the companies seek the partnership in the form of joint venture. And some example that we have seen in many occasions is large infrastructure construction project, often the result of joint venture of multiple companies that come together, sign the contract to act as one business entity. And of course, because these are companies that come to join together, they all have to have a pool of financial resource, physical and human resources, and spread the risk. We talked about risk before, if you remember, 2 weeks ago in lecture week 5, that risk is not always a negative thing. Risk is a certain level of uncertainty. If you are ready, if your company formed in a way that has various skill set, the uncertainty can pose you an opportunity for you to venture out to do something different, something new, and make profit. But if you are not ready and not your company is not ready or not flexible enough, this uncertainty will pose the risk on your company. So sometimes the large infrastructure project where it's so complicated and the value of money is so high, people seek out a partnership in a form of joint venture. And when the project finish, split up, go back to your own normal business. Now, what difference between this Venn diagram on slide number 8 summarize the difference and overlapping aspect of joint venture and partnership pretty good. And the joint venture may be for other purpose rather than profit. This we can see in a lot of kind of government infrastructure like road, rail. The main purpose is to provide citizens in the country, provide public services that they need. And when they come, of course, because you existed in the business world, your main purpose is to seek profit. And the joint venture will provide you a collaboration platform that you can work with other companies based on certain project. And each entity are liable for their own incurred debt, as well as if the project is successful and make a lot of profit, every company that join together will share those benefit and profit as well. Now, in the business, the collaboration for both joint venture and partnership, the main thing that both types of ownership has in common is the collaboration. Collaboration is the main goal. That's why we come to work together either as a joint venture or partnership, and the contribution of all of the resources. This is the main purpose of both structure ownership. The next type of ownership structure is the private limited company, Pty Ltd. You see a lot of this acronym after the name of the company pretty much everywhere you go, right? This is this Pty Ltd is short for proprietary limited, and it describes particular type of private company structure, right? This is quite commonly used in Australia. This private company, as the term says, is privately owned, and they are limited number of shareholders. They not open these shareholders to public. In other words, people who hold the share of this type of company are actually based on just only the inner circle of group of people who get together, right? And how will you find out whether which company is private, limited, or sole proprietary? There is a website, the government website, ASIC, Australian Security Investment Investment Commission. So this organization, this government body, has been set up to kind of overlook of how business, doesn't matter what type of business, operate in the business world, right? Private limited company. And the last type, which is public limited company. Public limited company. This type of company, majority of them listed in the Australian Stock Exchange. And why it is public? Because the company ownership is come through the public without any restriction. In other words, a public, general people like you and me can buy a share of the public limited company. Once you buy the share, you have some share of the company. You are part owner of that particular company. And this shareholding is free, is open to public. Anyone can come and buy the share. When they come buy the share, which means they put money into the company, you are investor and part owner of those company. But interestingly though, public company are required to lodge their annual account. All of the business has to lodge their annual account to ASIC. But interestingly, the picture that I got from the internet on slide 10 on your left-hand side, it's very interesting to see that top 10 construction company in Australia are actually not public limited. For example, number 10, Hansen and Youngkin, is quite large, 912 million worth contract in 2013 and 14 financial year. That's quite a large amount of net worth. Parkview, see, Hansen and Youngkin and Parkview, they are all private limited company. In upscale to John Holland, Wattpac, or even Brookfield and number 1 Lendlease. So this is probably common practice in Australia. Even doesn't matter how large, how small of the project of the no matter how large or small of the company, right? So far, we have seen 5 types of business ownership structure. All of those 5 types of company, at the end of the year, they have to lodge their annual financial report to ASIC. Why do we have to have this process? Firstly, so when the business operates, there should be someone to oversee or control and make sure that you run business in an efficient and clean manner. There is no dodgy business going on behind the closed door. So at the end of each year, the end of financial year, all of these companies has to lodge their annual financial report. And like you and me as an individual, we also have to lodge our tax income, right? And if we're doing everything correctly, everything just keep operating as business as usual. But every once in a while, we might be randomly picked and be audited. As an individual and a company, this rule apply the same way. So those activity is beyond our kind of scope of work as a construction manager. But one day, if you become your own company's founder, you have set up your company, you have to do that task. And I would recommend probably need to hire someone or have your accounting department set up in your company. Sorry. Now, so far, we have seen the structure of this, the type of the structure of the company ownership. Now we have to focus on how they manage their finance. Because our day-to-day job, these finance and business issues are actually not a thing that we accustomed to because we are a builder. It's the thing that's kind of a little bit far away from us because our nature of work is to build, to construct the building. But keep that in mind. Yes, your job is to construct the building, but there's no excuse though to say that you don't know anything about money. Because even as a construction manager, a small mistake that you do on site in terms of ordering construction material, managing the trade people to go on to work, or managing your program, it will eventually have an impact on the financial side of the project or of the company. Some small misjudgment could result in a big loss in terms of financial as well. So even though it's not your job for the time being as a construction manager, but you need to be aware of every action that you make, every decision that you make, it will eventually has impact on financial side. So what is financial management? It is anything that concern all of the decision involving money. Anything that involved with the money, that is financial management. It sounds a little blunt, isn't it, this definition? Some financial choice, such as the desire to stop building condominium or to free up resource, this can have substantially impact on the company finance. Now, let's have a look at some example close to us. You work on the construction site somewhere and due to some reason in a technical aspect of the building, some part of your job or your work has to stop. As a construction manager, you have to strictly follow the program or that Gantt chart that you have to look daily before you start your work every day. You have to make sure that everything following that line, that program. But sometimes some unexpected technical problem occur. You as a construction manager, you somehow has to find a way. If you cannot do task A today, and we put more people to do task B and C while we're waiting for some equipment related to task A to be fixed, this require daily kind of flexible adoption and plan changing that can happen every day. And all of those technical problem has impact on money side of the company. This slide, because managing finance is anything to do with money, right? It's so broad, it's so big, the scope is so large. I grab an essential thing that you need to know about financial and accounting from these three main books, right? The lecture content of week 7, 8, and 9. I grabbed some part of it from these three main books. I would actually recommend it for you to go and buy it. Why I think it's worth having it? Because these three books has been written in a way using the language that's actually for us, for construction people to read. It gives you enough, but not overly complicated things. These books, the first one is Financial Management and Accounting Fundamental for Construction by Daniel and Bolivar. Along the way in this slide, you will see and a number of points I reference this book. The second one, Construction Accounting and Financial Management by Stephen Peterson. And the last one, Construction Accounting and Finance Management for Construction Project Managers. The last one is more focused on you in your early career as a project manager by Lane Holm. Now, I did check in our university library website. The second and the third one, we have hard copy in the library, but sadly we don't have electronic copy. So while I'm suggesting this to you, for some of us, you might like to hold a hard copy. Some of you might like to hold electronic copies. These three books will be very useful when you manage construction project and company later on. Highly recommend. And by the way, I have got nothing to do with them. I didn't get any commission or anything. I just find this from searching large amount of financial books for us, for construction management people. I think these three are the best. Okay, move on in finance management. What do we need to know? What do we need to know to help us doing our job better, and also help us to help our finance department doing their job better? We need to understand the accounting fundamentals. These will bring into things such as term, the document, what it looks like, what the document comprises of, what to look for in those financial documents. The second, we also need to know the project-related finance matter. This particular point, number 2, you will be seeing it a lot in case study 2. If you haven't done so, I think this is a good opportunity right now for you to, because as I can see from my record, you already download both case study 1 and 2. Now you should start to read case study 2 in detail. I know it's not overly long, but I think read it only first time. You will not get everything. You have to read it multiple times because there are so many things hidden in the plain sight in the story. Right? You will see the action. You will see the action that Mr. Harrison has made when he operated his company. This is a lot of things that's going on in his action of day-to-day operating business that has impact on financial matter. Apart from the project level, you also need to understand a little bit more in the company financial level. Each one of these three areas will have impact on how you be successful in your career. As the definition said, financial management is anything to do with aspect of managing money. When it comes to money, we need a professional to help us deal with this issue when we run the company. Financial accounting is a professional, one of the professionals that they have been trained to dealing with this job. It's involving the capture of information regarding to anything involved with the money, purchasing, selling, either products or services of the company. Why do we have to capture all of this information, all of this paper full of numbers and columns? Because at the end of the day, when you operate it, you have to make a profit to be able to survive. If you form up the company and you're not making a profit, eventually the company will have to close down. How can we know that company making profit or not profit if we don't capture all of the information about money to help us see whether what we're doing is correct or incorrect? And all of this information of interest of revenue, either derived from the sale of product or service, and how much expenses we spend on in the company to offer those products and services, how much we put on human resources in our company. We have to keep track of everything. We have to keep track of everything. I think it's come down to the individual personal level. You probably can see if you are managing your own financial well, you know how much you're being paid, how much you spend. If you keep recording that, it will help you kind of see how healthy you are in terms of your financial aspect of life. Companies are running the same way. Why it is so significant for financing and accounting in construction industry? Around the world, construction business is the largest economic sector in the world. I'm talking about in the world, right? Everywhere around the world, there are construction projects going on everywhere all the time. So it creates a large amount of economic sector in the world. So we're talking about large amount of revenue and money flowing into the industry. We need to take a good care and capture all of those information right down to the company level and project level. And in a manufacturing product, operate in a way that's different to construction industry, right? The point number 2 and number 3 can be explained a little easier through this diagram. Now, if you look where my mouse is moving here, at the top line of this diagram, these are the nature of manufacturing process, manufacturing industry sector. Most of the time, people who manufacture some products, people who make products, actually has zero contact to people who's going to buy the product. You keep making it, you put a lot of investment in your research and development department in the company, you put a lot of trial and error, try to make the product, improve the product to the quality that you think it would sell. Up to this point, you still haven't got any money from your customer. Up until the point that your products hit the shelf and customer buy it, that is where money coming into your company, right? This process might take long, short, depends on how complex of that particular product. But along the way, there is no money coming in from your customer. These products timeline normally could take a month, months, or year. Like I said, depends on how complex or complicated the products are. For example, Apple company produce iPhone. They work like a year ahead of consumer. While we enjoying new release iPhone 12, the companies actually already have been working on probably iPhone 13 or 14 already, right? And you can see that Apple, as a company, manufacturing company, they release the products twice a year. The phone products alone, the telephone products alone, they release twice a year in March or April and June or July. And then in that regard, only phone alone, they subdivided the product, differentiated into submodels. This is because they try to gain market share in the telephone business in the world. Now they will get the money only when the phone release. All of the investment that company put in is their own budget. It's not money from the customer. Now, compared to construction industry, which is the second line below, construction industry operate differently, right? We, construction manager, builder, we produce the product, right? We produce the product, but our product is different to the iPhone. During the time that Apple developing their iPhone, you customer being cut off from the cycle. You're not going to see anything because everything is hidden behind their lab. And most of the time, the product will come out, whatever is come out in what way, what shape, what color. That's it. That's the only choice you have, customer. You can't choose anything more than they offer. But in construction industry, it operates different way. The product that you offer to your client, which is building, is actually a customized product. And when you build it, you have to answer all of your clients' need. In other words, you're not doing R&D behind closed door. You have to do everything as per client asks for. And our product life cycle also different to iPhone. One high-rise construction building project, let's say for argument's sake, it might take 5 years from start to finish to hand over point. 5 years, you're not going to get paid at the end of the 5 years. Otherwise, construction industry won't be able to operate. The payment, the money has to be spread along the way, along this process line. For us as a construction manager, you didn't have a chance to get involved into the project in the traditional design bid build project. You get involved right after the design is finished. right? So your involvement is shorter than other stakeholders in the construction project. Now, but if you are designer or consultant, you start to work right from the beginning, from the preliminary design. But at the end of each phase, you even not derive to the final products yet. So the payment term has to be divided differently along this timeline. It could be proportional wise. When the final design finish, you get a bigger portion of your payment. And then along the way during the construction stage, designer, consultant, you have to keep answering questions, clarify your design, and help builder to build it to finish line. And you will get another lot of payment at the finish line. So if this particular project takes 5 years, which means when you manage financial projects, it's going to be a multiple years aspect. If government require the company to submit to large financial report annually, every cent that you get from your client in each year have to be recorded accurately, right? Have to be recorded accurately. That's why construction finance are operating different to manufacturing sector, right? Now, this process is a long process, and it involves 4 activities, this financial management. The first activity, preparing financial statement for internal and external use, right? Your work as a construction manager on site, no matter what order, material, labor, all of the document related to a number or the amount of material, which is translated into money, the number of hours the tradesmen work on the site, different trade, you have to record all that. And hours of work equal money, right? You have to capture all this and feed it into your accountant department in the company. Now, along these 3 weeks, I will talk about the cost, talk about the content of the cost from the 2 main perspectives. From the construction manager perspective, and also as a construction company's owner's perspective. So this task, activity number 1, no matter what you do in your day-to-day task, almost everything will translate and relate it to money. So you have to keep all of the information about expense and incoming money in an accurate manner and feed it to your accounting department in your company. And this will also, when you capture everything, all of the finance information to put it in financial statement, it will then help you develop the next set of document, which is cash flow. It's come in the form of process of cash in, which is revenue, or cash out expenditure. Each month, company need to know how much cash or money that's flowing into the company and how much that's flowing out in terms of paying overhead expense, salary for your human resource in the company, the office rent, managing construction equipment. This is the second activity, cash flow. And the third activity, you have to prepare the tax for the Commonwealth government and state government at the end of each financial year. Now, you see, so far 3 activities, the work start to build up. And the last one, to manage internal finance affair within the company. This is the thing that you have to do daily. All right. Now you can see that this finance management is quite a complicated thing. And you, as a construction manager, you are already too busy with working, managing construction on site. How can you do this on top of your day-to-day job? It is impossible. That's why in the company that you work for, will need to have accounting department. And if you run your own company, you better focus on what you know best, which is a technical building constructing, and let professional accountant take care of this business for you. It will save you heaps. Now, this come to this point, slide 19. Slide 19. The fourth activity that we'll be looking at is to help us manage internal finance affair in the company. Right? Are we making money? Are we making profit? How do we know if we not capture all of those information, money in, money out? Are we returning enough of investment to our investor? You as a construction manager, you might not need to worry about this. Let your boss worry about it if you work in a large construction company where there is a shareholder to own the company, because at the end of the day, the profit that the company make is going to go back to the investor. And if you are a person who run your own company, you have to ask yourself, did you get return of investment from what you're doing every day? You also have to ask, are we focusing on the proper type of work? Are you focusing on the proper type of work? This link to the fourth question, is our company, your company, operating in the proper market? Now, question 3 and 4, if you read case study number 2 thoroughly, read it multiple times, you should think about this aspect. Because the company that Mr. Grant Harrison opened in case study 2, he started with landscape construction, right? Landscape construction. He started his working life as a landscape maintenance employees in the company. And then he decided to, let's make a change, come out, start up his own company, but he doesn't want to do the same kind of job that the company that he used to work for did. So he ventures to a new way of doing business. So he's looking at doing the job about landscape construction. Build the landscape, construct the landscape, not maintenance. Is he worked in the right market? Is he doing the right or proper type of work? If you keep reading the story, you will see he's actually differentiate his service in few others things that he offered to his client as well, right? I put the emphasis on read the story right through a multiple time, and when you write the first story summary, the case summary, as a construction managers, as a company managers, you should be able to pick up this information, because this is demonstrating that you understand how companies work in the market, business run, what type of products or service that company offer, what type of market that company operating in, right? This is the skill set that business manager must have. And also as well, while we are here in week 7, 8, 9, we're looking at financial statements, income statement, financial report and stuff. In the case study 2, we provide you with the landscape company's financial report as well. Later on in this week, we will look at those document and what it means, what are information is located in those documents. Have a look at case study 2 financial report. What sort of thing that Mr. Grant keeps spending on, and how much money that he actually make at the end of the day, right? That's why to be able to understand whether the company is healthy or not in terms of financials, you must be able to read the financial report. This is directly translated to activity case study 2, and also 1 and 2 will directly link to assignment 3 right at the end. If you are Mr. Grant, how will you operate the company, right? And you probably can see as well that the gap between assignment 2 and assignment 3 is quite small, because you don't really need to acquire a lot of knowledge, because you already have knowledge along the way from week 1 to week 10. Assignment 3 is a comparison between the case 1 and case 2. So you have to accumulate all of the knowledge along the semester to complete those assignment 3. Now let's have a look at typical accountant cycle. This slide 20, you see that it looks very complicated. This one comes from Home 2018 on page 7. If you can get hold of the book, I highly recommend. You don't need it to complete. You don't need those books to complete the assignment, but it will be handy if you know in detail of how they explain everything about financial in construction industry, right? Now, in the diagram on slide 20, you can see that we split the role and responsibility quite clearly into 2 groups. The first one is home office accounting. The second one on the right-hand side is the job site team. Like I have been mentioning since we start, whatever activity that you do on site as a site manager, it has impact on how finance will be managed in that particular project and eventually in your company. So the activity that you have to keep recording and feed information back is whenever you buy out a subcontractor, including cost coding, record all of the activity, labor, material. You have to capture the information, and you also have to put the right cost code onto it. I know it's overwhelming, large amount of information that you have to do daily, but this is part of the essential thing that you also have to do it. Why cost coding is so important? Because financial report at the end of the year is so nitty-gritty, lots of detail in it, and the home office where your accounting department sits, they don't have a broad range of knowledge, technical knowledge like you do. So you need to help them by capturing the right type of expenditure, right type of cost, put correct cost code into it, so they can then provide the accurate financial report at the end of each month and at the end of each year. And those information you capture will help them develop the journal entry, and also help them in the blue rectangular that I circle, help them update the cost control and also balance sheet, income statement sheet adjustment. Now, many of you study this course 4310. many of you already or should have done estimate 1 and 2, measurement 1 and 2 and estimation already. When you did estimation, you measure all of the things in the drawing, right? Then you put the money onto it. Each unit, each section of the thing that you build. And then when you put the money onto it, is you estimate how much will the project and product cost. If the project has that information, set of information from the estimation process as a benchmark, for example, building this house is going to cost 50,000 to buy a brick, another 50,000 to buy wood. That was estimation before the project start. When you're starting to work on site, you have to keep measuring when you order the material. Is it 50,000 for the brick, 50,000 for the wood? If these two are not matched, something going to happen and the financial report will not be balanced, right? It will not be balanced. I'll keep using the word balance. Along the way, you will see what I mean by the word balance. So you have to keep capturing those information to make sure everything you do on site is accurately captured, and keep monitoring and comparing with the budget that you provide before the job site start. Now, those three things that I put the blue rectangular around it are the common terms that you're going to be seeing, hearing a lot when you work in an industry. And these terms also, as a company owner, if you run your own company, these are the things that you have to keep your close eye on it. So from slide 21 onward, I will be introducing a number of finance management and accounting terms that construction manager must know. But before we start, I keep remind you again, you are not an accountant, right? Don't be too freaked out about it. You are not an accountant, therefore you don't need to know how things operate. You just need to know what it means. And later on in the example, you will know that I will show you some examples why accounting are so complicated. First thing first, journal entry, right? What the journal entry looks like. The picture on your right-hand side on slide 21. Journal entry is the record of the business transaction in the accounting book of your company, of your project, right? It's a properly documented journal entry consists of correct date and amount, either debit in, credit out, and some explanation, description of what are those things that you spend or receive on that particular day. This journal entry is the first step of the accounting cycle. Now, when you receive some construction material on site, normally they come with the either invoice or delivery document. You have to record all that and feed this information to your accountant department, the company. Second term, balance sheet. Balance sheet in the real format, it looks a little bit overwhelming with large amount of information. But what I really like about this summary from Halpin and Senior book is they make the diagram that grouping things that essential in balance sheet together in a format that it makes you look, they make it looks a little easier to comprehend. All right, the balance sheet is a snapshot of a company's financial asset, liability, and the value of the company's, that is, to its owner, and referred to as a net worth or equity. When you look at the specific point in time, either at the end of a month or at the end of the financial years. Now, balance sheet, sorry. In the balance sheet, there are three main things that you look for. First one, assets. Second one, liabilities. And the third one, owner's equity. What are those three things? The balance sheet is a snapshot capture information of at the point in time. The balance sheet is a list of asset and a liability and owner's equity, such as, for example, in this one on slide 23, the asset bit, there are so many subcategory underneath that, right? And the liability also has so many items underneath that, and owner equity also has a number of things underneath that. Let's have a look at it one by one. Assets are those resources that held by the company that will probably lead to some future cash inflow. In a broad sense, asset including everything your company owns, right? It includes everything that your companies own. Assets alone can be differentiated into six types. First one, the current asset. It is the thing or the asset that can be easily converted into cash. These include stock holding, inventory, short-term investment, marketable security, fixed deposit. This is sometimes called liquid assets. The second type of assets, is a fixed asset. It is the asset that cannot easily be converted into cash. For example, land, real estate, machinery, equipment, and furniture. It takes a certain period of time to convert those into cash. The third one, a tangible asset, are those assets that you can see, you can touch. For example, warehouse, machinery, equipment, office if you own it. The fourth type, intangible assets, is opposite side of tangible. These assets are the thing that you cannot see, cannot touch. It sounds a bit weird, isn't it? The thing that you cannot see and cannot touch, but it has value as an asset. Assets. Example of the intangible asset include a franchise agreement, patents, brand, trademark, and copyright. You can't touch it. It is not a thing. The fifth one, the operating asset. They are those that require the business to complete their day-to-day function. Without it, you can't complete their day-to-day business activity. The sixth type, non-operating asset, are those that are not critical for the company to run, right? Not essential for company to run, such as the brand value, the trademarks. Now move on to the second part of the balance sheet, liability. A second example on the slide 27. Liability is encompass commitment either money, contractual required, or work performance that the company has made to others. This definition extended to all the money that company must expect to pay. In other words, these are the thing that you already committed with your either supplier or your client. In some cases, the obligation is inherited in the contract and recognized within the liability section of the balance sheet, even though an invoice for payment has not been received yet. Now, this is when I said things start to get complicated. Information in here, in this section, liability, could be now money or future money that you expect to pay or expect to receive. This is why managing balance sheet at any point in time, normally the company would do it in a cycle period, like monthly, and at the end of the financial year. This will help you as a manager, as a company owner, to know where those monies are at a certain point in time. And example that I gave you earlier in slide number 17, because of the construction process are so long, when the project start until it's finished, this movement of money, when will you get the money or when will you need to pay the money, that need to be really, really managed in an accurate way. And liabilities can be divided into primary types, right? The first one is current liability. This type of liability refers to immediate debts that must be paid within 1 year. For example, the money that you owe supplier or vendor. The second type is non-current liability, also refer to a long-term debt that you obligated to your company. You must repay over a year's time. For example, of non-current liability would include things like business loan, business tax, deferred tax liability, mortgage, and lease. What happened with the current liability? If you're supposed to pay whoever you're doing business with within a year, if you don't, you'll be in a legal problem. The third part of the finance statement is owner's equity. It's comprised of special type of liability, like money that company owes its owner, right? Because some company exist in a certain way, certain ownership structure, like when we start week 7 lecture earlier, owner put investment into the company and companies has this equity. So at the end of the day, whatever the profit that company made, it has to go back to the owner. So that's why this money is sit within the owner's equity. More accurately, owner's equity is residual money amount after deducting a value of all company liability from the value of its asset. All of these definitions recognize that a company must give priority to pay, right? The company must pay their creditor. Who is creditor? When you're dealing with the company and you must pay them, such as supplier or client, it is by law that the company must pay people that the company owe before pay back to its own owner. right? It must pay the business creditor before its owner and shareholder. This perspective is how companies' owner relate their investment to the company. Now, owner's equity also include the main two main accounts. The first one is the initial capital that owners provide to start up the company, and also all of the profit that they have chosen to retain to reinvest in the company. This depends on what sort of agreement and contract that you set up earlier when you form up the company. For example, if this year your company make a profit $100, will you take that $100 out, or you take only $50 out and keep $50 put back in as a returning earning? Even this nitty-gritty activity like this also need to be recorded correctly in the balance sheet. So fundamental relationship between these three things: asset is equal liability plus owner equity. This is called the fundamental accounting equation. It has to be equal, right? The asset has to be equal liability plus owner equity. What happens if it's not equal? If it's not, something wrong with your financial of the company. And because it is equal, that's why they call it balance sheet, because the two sides has to be balanced. The fundamental equation also holds true for any balance sheet. Doesn't matter company, doesn't matter how big, how small the company. The profit, either they are profitable or nearly bankruptcy, has just received a large amount of some money. When the company is working, operating correctly and healthy, these two sides of the equation will be balanced. And when I said, what happened if it's not balanced? And I mentioned that there must be something wrong with the financial management. If it get to the state that the asset has value, market value, a lot less than liability and owner's equity combined, which means the company is going to close soon. Let's watch this quickly together. And at the end, where would you allocate construction tower crane in an accounting equation? Let me switch quickly.
With Plus 500, getting started is simple. And once you...
Hey guys, I'm James and welcome to the very first episode of Accounting Stuff. In this video, I'm going to talk through one of the most...
I can't see any audio, video, sorry.
Okay, you can't see video. What can you see on your screen?
It just has the blank picture of you. It's when I hover over it, it says Cinnamon.
Okay. Let me see. What about now?
Yep, just switch now. I can see it.
Okay.
Some principles of accounting.
It's still showing okay?
And run through how it is used. This episode is
yeah, showing good.
It's going to be part of a playlist that I'm creating on accounting basics. I will add links to the rest of the videos in the series to the description below. So, why the accounting equation? This equation lies at the heart of accounting and is the foundation of the double entry accounting system. I hope you find it informative. Let's do this. The key principle behind the accounting equation is that stuff the business owns is equal to the stuff that the business owes. And it is vitally important that you remember that this equation balances always, always, always. Now, let's say I come up with this amazing idea for a business. I want to make popcorn and sell it. I've got $5 in my pocket and I decide to lend it to the business. Now there is a word to describe the stuff that the business owns, and that is called assets. On the other side of the accounting equation, we actually have two different words to describe what the business owes, and that depends on who the lender is. We use liabilities to describe what the business owes to third parties, and we use equity to describe what the business owes to its owner, in this case, me. So assets equal liabilities plus equity. There we have it, the full accounting equation. Simple, hey? So that $5 that my popcorn business now has is called an asset. And that $5 that my business owes back to me is called equity. See, it balances. Assets can include things like cash, accounts receivable, inventory, plant, property and equipment, land and buildings, investments, and goodwill. Whereas liabilities can be made up of accounts payable, loans payable, wages payable, and taxes payable, amongst other things. The most common forms of equity are stockholders or owner's equity and retained earnings. I will cover retained earnings in detail in a further video, but for now you can just think of it as profit held for future use. Now let's add some totals to the above and see if this thing still balances. Of course it does. The accounting equation always balances, and a balance sheet is basically a snapshot of our different assets, liabilities, and equity at a single point in time. A balance sheet is one of the most important financial statements. There is a lot you can tell about a business by looking at its balance sheet. Right, so at the beginning of this video, I promised you a couple of examples, so here we go. If I head down to the shop and spend $5 on corn, then I no longer have $5 in cash, but I now have $5 of inventory. The categories have now changed, but my total assets stay the same. My balance sheet is in balance. Now I need to pop this corn, but I don't have enough money to go and buy a pot. So I go to one of my friends and I ask them if I can borrow $10. The business's cash increases by $10 and loans payable go up by $10 as well. Total assets are now $15 and my liabilities plus my equity are now also $15. We're still in balance. I then go and spend this $10 on a pot. My cash goes down by $10 and my equipment goes up by $10. Let's say I go and sell this first batch of popcorn at a 60% markup on cost. So I've made sales of $8. All my inventory has now gone. However, I now have $8 in cash and have made a small profit of $3. My profit is $3 because my sales were $8 and my corn cost me $5 to buy. 8 less 5 is $3. Remember I said that we can think of retained earnings as profit held for future use. So my retained earnings are going to increase by $3. Because my business has made a profit of $3, my total assets have now increased from $15 to $18. So to recap, in this video, we have learned that stuff that the business has is equal to the stuff that the business owes. This can be reworded to form the accounting equation, assets equal liabilities plus equity. This equation always balances. The expanded accounting equation forms the balance sheet, and the balance sheet is a snapshot of a business's assets, liabilities, and equity at a single point in time. Whew. If you've made it this far, thank you for watching. As I said at the start of the video, I'm making a playlist on accounting basics, so soon there are going to be a bunch more videos just like this one. If you have any suggestions for topics you'd like me to cover, let me know in the comments and I'll see what I can do. If you're really keen and would like to do some extra reading on the subject, I can recommend this book by Daryl Mullis and Judith Orlov. It's called The Accounting Game, Fresh from the Lemon Stand. I think Daryl and Judith do a really good job of explaining some of these accounting concepts in an intuitive way that is easy to follow. I'll throw a link to it in the description below. That's all for today. Thank you for watching.
Yep, let me switch back to the PowerPoint screen here. I think this guy did a pretty good job in summarizing the finance balancing sheet and fundamental finance equation pretty well. But I think there was something in there that a little bit complicated when I say it. you can see when he borrowed, when he has initial $5 to invest in his coin. He has $5, he go out and buy a coin. Then that's $5 in the asset column. It changed the place from cash into inventory, right? It changed where it's located from cash into inventory because he has a coin instead of $5 cash note. And then when he borrowed $10 and go out to buy a pot, he has, at a certain point in time, he has $10 cash. And once he buy a pot, it changed the form from $10 where it's sit in the cash and come back down to inventory again because now he has pot and coin. And now the value of pot and coin combined together become $15. Now, the complicated thing here for us, that is popcorn, right? That's kind of basic and simple balance sheet. In construction industry, where would you allocate the construction tower crane in the accounting equation? I leave this question for you to think about. Scenario 1, if you own it, right? If you own the tower crane, it is your asset. Where are you going to put it in the balance sheet? Second scenario, what if you're not owning it? You rent it. And this construction tower crane is quite costly even when you rent it or release it. Where will that amount of money sit in a balance sheet? Right? It is, like I said earlier, this nitty-gritty fine detail is quite complicated, right? It's quite complicated. You need to have, when you run your own company, you need to have accountant department. And when you work as a construction manager for the company, for any company, your company must have accounting or finance department to help you sort all this out. But they need information from you. Let's move on to the second set of document. The first one is balance sheet. The second one is income statement. Income statement is a sum up total of all of the business that the company did for the period of time, right? Usually a financial year. It can also be prepared quarterly or monthly. The income statement combines revenue and cost, and also known as profit and loss statement. This income statement reflects the difference between the balance sheet, two balance sheets, and were both snapshot at some point in time. Now, let's go back to the definition from Harpin Senior again. The diagram on slide 35, in a schematic way, diagrammic way, to differentiate four main parts of the income statement. Now, let's freeze that idea of the balance sheet that you know earlier for now. Let's move on to this, and then towards the end, it will come to meet together again. Income statement is where you analyze your company's profit, or in some case, losses. It should come with no surprise that income statement is commonly referred to profit and loss statement. It's to remain financially healthy, the company must regularly generate more revenue, right? To be a healthy company, you should regularly generate revenue, and at the same time, you should minimize the cost of the goods or products, and also the general expense. If you can maintain this, then your company is going to have a profit. Now, the income statement has four parts. The first one is revenue. The second one is cost of goods sold. Cost of goods sold, which in bracket direct cost. The third component, administrative and general expense. And the last one, profit. What is revenue? Revenue is is the value earned by the company through the sale of goods, products, or service during that particular period that's being captured in this income statement. I mentioned earlier, it can be monthly, yearly. And clients accept obligation to pay the company because they expect to get products or service from you in exchange, right? So it has to have some information about the product or service that you offer to your client, and also the amount of money that they expect to pay you. Revenue, this item is also referred to the net sale or turnover. It is the value earned by a company during the period that you captured the information. And for most of the revenue generated by a construction company, it is attributable to work on a company project. It's sometimes also referred as operating revenue because you manage construction project, and every single activity often has financial transaction, so it has to be captured in this income statement. The second part, cost of goods sold. In general, this component refers to the money spent to purchase the object that are in turn sold to your client or paid for operation directly related to the purchase. Often, good sold is called direct cost. For construction company, usually in the report, at this section, we're referring to the cost of labor, material, equipment, subcontractor, or sit right under the direct cost. Gross profit. This term, this is different between the total revenue and the total cost of goods. In other words, how much you sell, how much money that you get from the products or profit minus the total product cost. The result, if it's positive, that is your gross profit. Gross profit is not the same as the net profit. There is a big component separating gross profit from net profit, namely all of the overhead costs. For example, for a company, you have overhead costs when you run the office, right? You have a number of personnel working on all documentation and everything. And office rent as part of those overhead costs. That's why the construction company try to minimize the overhead cost, right? Try to minimize the overhead cost because they try to increase the gross profit. Next thing, the expense. Next term that we have to know about. The expenses. Business expenses are the cost that is ordinarily necessary to run the business. These expenses are the costs that the company incur each month in order to operate. These include rental, utility, gas, electrical, water, if you run the office, legal cost. If you run your own business, and you don't have accounting department or personnel in your company, you have to somehow get this service from outside. This is the expenses you pay to get that legal service cost. This is the cost of legal that you pay to get the service to help you managing your finance and accounting. Employee salary, contractor pay, and the marketing and advertising cost. Now, while we're here at the marketing and advertising cost, I'll link back to case study number 2. Towards the back of the case study 2, you will see that the document including balance statement information, balance sheet information statement, and cash flow, which we will look at it later. It's also including information about how Mr. Harrison doing the marketing activity for his company, right? He used or acquired some sort of software to help him present the project to client better. That marketing cost and advertising cost is part of the expense that you ordinarily use when you run the company. When you read the story, think about it. Does it make sense? Did he do the right job or not? He spent a certain amount of money on that marketing cost. Did he give back what he expected or not? And the last question, I think the last question asked was, if you are Mr. Harrison, what will you do? Will you do it differently, or will you do the same as he did for his company? Right. Let's move on. The expense is generally grouping all of these 4 important types of expense together. In the income statement on the slide 35, they put that category as a cost of goods sold, right? This sit right under the expense of that the company need to spend to be able to to help them operate business. Cost of goods sold frequently address the construction industry as a direct cost because it normally has items such as labor, material, subcontractor, and other direct costs. Right? You can't. This is part of the business. We have to have labor. We have to have material, and sometimes labors and material is not quite cover everything. If you rent or lease some equipment, you also need to pay someone else to do some task for you. That also part of the other direct cost. The second one is under the expense is the general and administrative expense, right? This usually referred to as a general overhead. These are all of the admin activity that happen in the office to help you manage things on site. The third one, interest expense. If you rent equipment, right? For example, if you rent for the rent of the equipment, or you borrow money to operate your company, you also have to pay interest. That is interest expense. That's part of your company expense. And the fourth one, tax expense. In short, the share of the company's profit must be paid to the government. The income, the profit that you make for the company, it has to be taxed, right? So that is part of the tax expense. Now, move on to the next bit. Net income or profit or earning. All three are synonym. Is the money left after all expense have been subtracted by revenue. This leftover belong to the company's owner and is their reward for tying up their money to put it to put in the company's investment. So at the end, the net income after you deduct the tax, this is where it's going to go to all of the shareholder. But earlier in the slide, I mentioned that the obligation is the company has to pay everyone else outside the company before it gets to the owner. Net income is the company's bottom line. We start the business and business existed to make profit. So we call this net income as a net profit as well. It has to be balanced, same as balance sheet. So the net income is equal revenue minus expense. Which means what? If you increase revenue and you decrease expense, that is a bigger profit that your company is going to make. No matter what you do, as a construction manager, if you work strictly follow program, if you work smart, put effort onto it to manage site activity well, you will help your company reduce expense when the revenue is already fixed, because you normally the company get the job as being awarded contract after bidding process. The revenue money is already being set. This is how construction industry works. So the revenue fixed, how can we get more profit? Reduce the expense. Let's watch this together a little bit more. This one also is short. Let me switch.
When you think of accounting and
it's showing okay, right?
Comes to mind?
This
Yeah,
video
I can say good.
Yep.
A solid introduction to
Thank
the
you.
balance sheet in accounting. I'm going to explain what it is, how it's all laid out, and then we're going to build ourselves a balance sheet from scratch using Google Sheets and 6 example transactions.
This one is 12 minutes long. It captured pretty much tidied up everything together. I'm just being mindful about time. Let's watch part of it together and then I'll move on into the next bit of the slides.
Hello there, welcome back to the channel. I'm James, this is Accounting Stuff, and in this tutorial, we're going to cover the balance sheet accounting. The balance sheet, or statement of financial position, is one of the 3 major financial statements, along with the income statement and cash flow statement. So this is a big topic. If you run a startup, then you absolutely must be able to prepare one of these in order to have a hope of getting funding. And on the flip side, if you're ever planning on lending money to or investing in a business, then it's critical that you know how to read and understand the balance sheet, because the balance sheet will give you an impression of the business's financial health, and that will determine how risky the opportunity is for you. And finally, if you're an accountant, then chances are you'll be helping prepare one of these at the end of every accounting period. Over the past few months, I've been posting weekly videos teaching accounting basics for beginners that you can find up here. This video is going to link a bunch of these ideas together, so if you find any parts of this explanation confusing, then I recommend you check those out to cement your understanding and come back to this one if you need to. There will be links in the description below to all of the relevant ones, so feel free to check those out. As I mentioned, I'll be releasing new videos each week, and I aim to cover all of the major parts of the balance sheet. So hit the subscribe button and click on the bell to be notified when those come out. Don't know about you, but I'm itching to get cracking. I mean, what is the balance sheet? Let's find out. The balance sheet looks like this. The way it's presented can vary, but there are some key elements at the core of the balance sheet that the rest of it's built around. Here we have a balance sheet for a business called Craig's Design and Landscaping Services. That's because I took this one from the sample company in QuickBooks Online. QuickBooks Online is the biggest cloud accounting platform in the world, and they specialize in small to medium-sized businesses. So I thought this one would make a good example. If you're thinking this all looks a bit crazy, then no worries. I'm only showing you the finished product. We'll piece together a simpler one of these for ourselves in a moment.
Let me pause it for a little bit. As you can see here, it like what I told you earlier in the before income statement, this balance statement has three main components: asset, liability, and equity. Sometimes equity in some statement sheet, they separate between liability and equity. Most of the time, you will see the liability on the top part and equity, owner's equity at the bottom part. So we saw this balance sheet already. And let me move on to show a little bit more.
Right, I think it's time for a definition. A balance sheet is a snapshot of a business's assets, liabilities, and equity at a single point in time. And that's exactly what we're looking at. We have assets over here on the left, and on the right-hand side, we have liabilities and equity. Beneath both of the headers, we have all of the detail, all of the individual groups of accounts summarized with their closing balances. At the bottom of the balance sheet, we have our total assets and total liabilities plus equity. You'll notice that both of these numbers are exactly the same. That's what we want to see. It's the aim of the game here, because the balance sheet, as suggested by its name, always has to balance. So your total...
Yep, let me stop here. That is the first repeating the balance sheet that we talked about it earlier. But he mentioned in this clip that the balance sheet is going to link to income statement and the cash flow. This is what the second part that I would like to show you.
1, 2, 3,
not Timberland, but
back
later.
verbally to you.
In this video, you'll learn what an income statement is. I'll show you what it looks like and how you can use it to measure a business's financial performance. Hey there, welcome back to Accounting Stuff. I'm James, and in today's video, we're going to cover the income statement, also known as the profit and loss statement, or the P&L for short. This is one of the three major financial statements in accounting, along with the balance sheet and the cash flow statement. Collectively, these reports give us an impression of a business's financial health, so it's important that we understand how they work. I've already made videos covering the balance sheet and the cash flow statement, which you can find linked up here and down below in the description. But up until now, I haven't posted a video yet on the income statement, and I've received a lot of requests from you guys to cover this topic, so thanks for all these, particularly from one subscriber. So Niloy, if you're watching, this video goes out to you. Good luck in your exam, hope you crush it. An income statement is the summary of a business's revenues and expenses over a period of time. In its basic form, an income statement looks like this. It's a summary of a business's revenues and expenses over a period of time. When we take our total revenue and subtract our expenses from it, then we work out our profit or our loss. We make a profit when our revenues exceed our expenses, and on the flip side, we make a loss when our expenses are more than the income we've earned. This is why the income statement is also known as the profit and loss statement, or the P&L for short. It lays out a roadmap for how we ended up here at the bottom line, our profit or loss. The income statement always covers a period of time, which could be anything that we want it to be, but typically we run it for a month, a quarter, or a full year. Here's a helpful analogy that I read in this book, The Accounting Game, which I recommend reading if you're new to accounting. You can find my review of it up here. Anyway, back to it. If a balance sheet shows us a snapshot of a business's assets, liabilities, and equity at a single point in time, then you can think of it as a photograph or a still frame taken from a video, whereas the income statement covers a period of time. It's like watching a clip of that video. It has a beginning and it has an end. And if we look at it carefully and analyze it, then it can tell us a story. But more on that later. Let's take a closer look at our income statement. Revenues less expenses make us a profit or a loss. The problem with this layout is that it doesn't give us much detail. It would be much better if we made things a little more descriptive. For instance, revenue. There are many different types of revenue. If we were running a business that sells physical products, then we might want to call this product sales instead. Or if we provide services, we could call this our services rendered. This extra detail helps the readers of the income statement better understand what they're looking at. Clarity is the aim of the game here. The same goes for expenses. Businesses typically incur many different types of expense, but broadly speaking, these can be broken down into two categories: our direct costs of doing business and our indirect costs of running the business. Our direct costs of doing business are the costs which we can directly trace through to the products we've sold or the services that we've provided. For a business that provides services, we might call this our cost of services. And if we sell physical goods, then we could call this our cost of sales or our cost of goods sold. Direct costs like these are variable costs, which increase in direct proportion to the sales that we've made. If you were running a retail or a wholesale business, then these would include things like the original purchase price of the product that you're reselling. Or if you run a manufacturing business, then this would include the cost of your raw materials or the direct labor cost.
Cinnamon, the sound's cut out for some reason just about a moment ago. Cinnamon, I'm not getting any audio.
This is the residual amount that's left over after deducting all of our direct and indirect costs of doing business. So this is our basic income statement. But how does it help us measure a business's financial health? It does that by giving us a means to compare our financial performance against comparative accounting periods. A comparative period is a different period of time. It can be whatever we want it to be. We could compare current month income statement against last month's income statement, or this year versus last year. When we use comparative periods, we can calculate the change or movement across each line item down the profit and loss statement. And as accountants, it's our job to support these movements with a narrative which explains all of the differences. Let's throw in some numbers into an imaginary company, and I'll show you what I mean. We'll compare the movements in our P&L year on year. This is going to be for a medium-sized business, so we can quote our numbers in thousands of dollars. What have we got here? Our imaginary company has made sales of $110,000, which is up $10,000 from what we made in the prior year. Our cost of goods sold have also increased by $10,000. from $30,000 to $40,000. That's left us with a gross profit of $70,000, which has remained unchanged. Our overheads are fixed at $45,000, which gives us an operating profit of $25,000 in each period. What can we learn from all of this? Well, our sales have increased by $10,000, but our gross profit has remained exactly the same. How can that be? A useful metric that we can use to analyze this is gross profit margin. We can calculate our gross profit margin by taking our total product sales and deducting our cost of goods sold, and then dividing the whole lot by our product sales. This measures how efficiently we've been producing and selling our imaginary product. In this case, our gross profit margin in the current year is around 64%, which is actually down from last year's gross profit margin of 70%. How's that possible? Well, one of two things could be happening here. Our sales could be shrinking, or our costs could be rising. We could be selling more products, but at a discount, or the cost of our raw materials could be rising. These are the questions that we need to be asking ourselves as accountants, investors, or small business owners. We can compare metrics like gross profit margin across comparative periods to help us identify what questions we should be asking. And then that's when the work begins. We need to find out the answers and use them to build a narrative that explains what's going on. Gross profit margin is just one of many business metrics that we can use to analyze the income statement. If you'd like to see me make videos on the others, let me know. Now, this is still quite a basic income statement. In reality, there are other indirect costs of doing business which we might need to include as well. Things like interest expenses and tax. These tend to slot in below operating profit because they aren't considered to fall within the normal cost of operations. This is why operating profit is also known as EBIT, or earnings before interest and tax. When we deduct our interest and tax from our operating profit, we calculate our net profit, the bottom line, because it's at the bottom of the profit and loss statement. So you can see that there are many different types of profit and loss to consider in accounting. We start off with our revenue and we deduct our direct costs of doing business to come to our gross profit, our top line profit. Below this, we take out the indirect costs of running our business to find our operating profit, our EBIT, our earnings before interest and tax. And when we remove interest and tax, we calculate our net profit, the bottom line. Together, these different types of profits help us measure performance over a period of time. The main goal of most businesses is to maximize their profits, so it's important to be clear on what that means and to be aware of the differences between gross profit, operating profit, and net profit, which can each tell us a different part of the story. Like I mentioned earlier, the income statement is just one of the three main financial statements, along with the balance sheet and the cash flow statement. I've made videos covering both of these already, which you can find here and here.
Right, let me stop here. As you can see that the three things that he mentioned, like I mentioned earlier, balance sheet, income statement, and cash flow statement, they are all linked, right? So to manage, imagine if you are a project manager, you have your accounting department to help you with this. But if you are the company's owner, you have to think about these three things because it all interconnect. Whatever decision that you make daily on what you're doing on day-to-day job, which help you limit it or control the expense, right? Once you can control the expense, try to minimize it. That is when you can earn or gain more profit from the project. Why expense to me sounds like it has more weight than playing around with the revenue or the sales, because sometimes when you develop your products or service, let's say you provide, like Mr. Grant Harrison in case study 2, you provide wonderful services on landscape construction, but the revenue or the sales of service, you can charge your customer only to a certain point. It will hit the point where the client or the customer will think whether is that worth paying or not. So most of the time, sales of goods, sales of products, sales of service often has to rely on the market price as well. You can't just double charge of your client because you think your service is wonderful, right? So if we have less room to play around in the revenue or sales of goods and service, what you can control is how you operate your business with less expense. This is how a big company make a profit in being successful. Now we have few more things to cover in the slides, but I would like to show you this while I'm here. These are the example, right? These are of a real financial document from John Holland. This is publicly available. You can see it on internet. I just paste the link here on slides 44. Let's have a quick look of how are they, what it looks like from a real document perspective, right? So this is profit, income tax expense, and profit attributed to the owners of John Holland. The unit is 100,000. So at the end of 2017, the profit is $58 million. Yeah, right? Because it's $100,000 unit. So it is 58 million. It's quite a lot for a big company like this. And in this company, because this is legal obligation that the company has to release financial report for transparency purpose, and they are also for tax purpose. Follow the link that I provide for you on slide 44 and have a look inside what sort of thing that big companies such as John Holland is doing, what sort of services or products that they offer to their client. It's quite a lengthy document, but I think it's worth having a quick read through it. It's got nothing to do with the assignment, but have a look at how they provide or prepare the document like this. And of course, when you work for the company, even though at the end of the day, this is not your responsibility to produce this kind of document, but everything you do daily on your site management task will have impact on how accounting department will prepare this document. Okay, let me switch back to the PowerPoint slides again. Sorry for the hiccup about the sounds earlier. Slide. Okay. So far we know balance sheet, income statement sheet. Let's move on to cash flow. Try to do it quickly. Cash flow is the overall movement of fund, right? The information from the video that we looked at earlier, he mentioned that balance sheet is a snapshot. It's a snapshot, right? At a certain point in time. But income statement is kind of period. It captures information in a period between one point in time to another point in time. So that two document feed information into cash flow statement. It is overall movement of fund coming through the business each day or month, right? Each month, at the end of every month, you have to check whether how much money flowing in and how much money flowing out. And for instance, cash flow into your business from client, customer who purchase your products or service directly, or through the collection of debts that other company has to pay you, from account receivable. This is another term that he mentioned in the video, account receivable. On the other hand, the cash flow out of your business is where all of your expenses will be listed in here, such as rent, utilities, tax, or account payable. Now, you see two new terms here on this slide 45, account receivable and account payable. Account receivable is where you get the money. Account payable is where you pay your money out of your company. Normally, cash flow has its cycle, similar to your personal checking account. So the money coming in, if the money coming in more than going out, your company is healthy. The balance, the difference between the two are positive. But on the other hand, if the money is going out more than coming in, the result, the difference will be negative, which will put your company in the red. And you don't want that. Sometimes, because construction company operate in a long period of time due to the project life cycle manner. Sometime, certain month, you might be in the red because you know that next month a certain amount of money will flowing in, and it is essential to keep record of all of these cash movement each month. This will help you see how healthy your company's financial is. And the statement of cash flow is so important that this additional report is provides summary of change of the amount of available cash as well, right? Money coming in, money going out, and which if you are operating in the positive, money coming in more than going out, it's showing that your company is healthy. And how can we get or prepare this cash flow statement? To be able to do cash flow statement or the statement of cash flow, we need a balance sheet at the beginning and at the end of the report period, as well as income statement for that particular period. This example that I show you on your on your left-hand side is the slide that I showed you earlier in the balance sheet. Cash and cash equivalent of the current asset we have here is 2.4 million, right? In the statement of cash flow, it must show the same number, right? Because it's balance sheet, money, the asset equal liability minus the asset equal liability plus owner's equity. It also must equal the same amount of money that listed on the cash flow statement. See, 2.4 million, same number. If you look at the example of John Holland statement that I showed you earlier, you will see this happen exactly the same way. Let's have a look at this example of the company that I get example from the books. This company cash flow statement showing operating activity, right? Operating activity. What happened along this line of operating activity is list all the cash inflow that resulted from the activity that company provide or running their business, right, to their client. This section begins with the company's net income. You need the net income for the period and then add or subtract all of the non-cash items. And along the way, you also have this another term called depreciation. For the period is of special interest for construction. This account is an allowance for decline in value over time of equipment and capital asset. Companies consider their asset depreciation as a cost. However, since it does not involve any cash, depreciation is added back to original net income of the cash flows adjustment. All of the, for example, all the construction equipment or machinery that you purchased, the longer period that it gets, the value of those equipment and machinery will decrease. This is called depreciation. Account receivable, right? Account receivable is the amount of money that the client owes your business. You provide your client services or products, they must pay you. The money will coming in through account receivable. And the other type of account, the change in account receivable is a subtract from the starting net income, because this amount does count in the computational net income, but does not involve any cash. The subtraction must account for algebraic sign of the change. If the change is negative, in other words, a decrease in balance in one year to the next, then the subtraction increase the net income. The change in payable account, this is when you pay your money out, the cash flowing out of the company. Investing activity, expenditure on fixed asset, for example, any movement of cash or converting of your asset into cash. Financing activity, right? Any cash received from a new loan is included here. This money increased the cash flow for the period. Conversely, loan payment as considered negative. This section also includes any issue company's stock, which result in infusion of new money and therefore increase the cash flow. As you can see so far, it's very complicated. There are lots of things going on underneath each section in the cash flow statement, right? And for us, for you as a construction manager, now how can we track all this? The answer is, I think it is, the immediate answer will be, this is not your responsibility as a construction manager. You should be aware of the term and how money move and how to read the cash flow statement. But how to put things in under certain category, why it's not being located in under any other category, that leaves this job to the accounting, right? The accounting department will take care of this. But if you are a construction company's owner, you probably definitely need to seek a lot more additional knowledge on finance. I think this is when this is what happened in the business study. I mentioned to you earlier, probably week 1, that if you decide when you finish this BCM program and you decide to be a construction manager, it's fine. Just go and get a job working as a construction manager, and then along the way you're climbing up your organization hierarchy to become a manager and so on. But one day, if you decided to, all right, let's leave the company and set up your own company. Leave the company that you work for and come up and set up your own business. I would recommend you to, before you do that, maybe go back to the university and study a course like MBA, Master of Business Administration. That a year or year and a half master degree program will provide you with a lot more detail on how to manage finance. And you will definitely need that if you're going to come out and start up your own business or your own company. I'll tie this back to case study number 2 again. If you look at how Mr. Grant Harrison made his transition from being an employee within the landscape maintenance company, he thinks he knows a lot about the business. That's why he decided, oh, that's not my kind of thing. Let's come out and set up his own landscape construction company, right? Yes, even though they still operate in the same industry, which is the landscape industry. But there are lots of things in there that are different. And when you read the story along the line, you can see the hardship that Mr. Harrison has to go through managing money, managing people, managing marketing. A lot of activity going on there, right? Don't be overwhelmed by the number of content and context that you're going to learn from week 7, 8, 9. It just provides you introduction to the money side of the business. To wrap up about the cash flow and cash flow statement, cash flow is, or CF, must equal cash inflow minus cash outflow. If it's not equal, the company will be in imbalance, and you definitely don't want to go into negative, right? Also, at the same time, how come can it be super positive? Let's say cash flow, you have inflow more than outflow at some period when you're operating business, when all of your clients pay you at the same time while you're still maintaining the normal level of operating. This might be the case when cash flow in has more value than cash flow out. But what you don't want is cash flow out more than cash flow in, right? And I'm being mindful about the time. This slide, this YouTube clip that I provide will link you to the same dude that you have been watching the first 2 clips, but this one is going to look at cash flow statement. The reason that I choose this person YouTube clip and provide it as a summary of these 3 sections: balance statement, balance sheet, income statement, and cash flow statement, is there are so many other clips in the internet, like large amount, but I think he make the clip that easy to understand and bring it down to the basic. And I think it's suitable for us in this course because there's so many other complex, a lot more complicated YouTube clip, or even something like TED Talk or LinkedIn Learn that provide a lot more complicated stuff. But I think this is a lot easier to comprehend at the beginning level. All right, so far, the journey so far. From week 1, we're looking at management principle, then organization behavior, organization system, organization process, decision making, managing people, information supply chain, and that information supply chain last week, lecture week 6, we also touched on the marketing bit as well. Now, this series from week 7, 8, 9, we start with finance, managing finance. Let me tie back to assignment case study number 2 again. When you read the story, There are a number of things that happen to Mr. Harrison's business, right? That happened to Mr. Harrison's business. This is a skill or essential observing skill that you must develop when you study the course about business, is to look, to read, and put a little bit more analysis onto what you read, especially in the business world when there's so many things going on, and when you use analytic, read it and analyze it at the same time, you try to work it out. What are the cause, what are the effect of each action or each decision that someone's made when they're operating their business. So, and the reason why I choose case study number 2 as one of the assignment or as assessment item is because this is a startup company setting. It's not multinational national company or super large construction company, which are financially a lot more complicated than this little company. So because this is your first encounter of the money side of the business, that's why I choose this small startup company. And how can this skill help you to look at the financial side of the construction industry? We have to start somewhere less complicated. That's why startup company is very interesting example that we can learn from, right? And there are 4 questions that I put into the rubric, and the question that you need to answer when you read the case study number 2. The first one: if you were Mr. Harrison, would you like to continue business, or do you want to make a significant change? If you are Mr. Harrison, what will you do? When you read into the story, how many services that Mr. Harrison provide to his customer, right? Have a read the story. How many types of services that he provide to his customer? He started with constructing the landscape, building the garden, building the landscape for residents, and then he branch off to do few other things. If you are Mr. Harrison, what will you do? Right? So before you can answer this question, you also need to know what are the other things that Mr. Harrison did offer to his customer. And among those things, can he execute that himself, or does he need anyone else to come and help him do the job? This is operational bit of his company. And what about marketing bit? What did Mr. Harrison do in terms of managing his marketing? How will customer knows about his services? Through what channel? Is those channel effectively done? Does it bring lots of customer to him or not? You have to read that as well. It's in the story. And second question, when you look at the landscape finance statement, the company finance statement, what are the things that you think you can do to move the company forward? Have a look at his revenue, income, and expense. Does it make sense, or does it balance? Either yes or no. What will you do to move the company forward? Right? And the last question that we ask is: should Mr. Harrison be concerned about the lack of employees royalty. You will see in the story, in case number 2, that people who work for him keep leaving him. This is, even though it is not about finance, but it is totally related to how you manage people, right? How you manage people, which means you will need to revisit and look at the content from week 3, 4, and 5, right? Because Mr. Harrison hiring people to come and help him, but there's some action in there, something happened in the business that he cannot retain those people who work for him. Read the story, try to read and reread and see what's going on in there. Then make a summary of this whole story. Tell me what happened in this case, which is your first question. Make a summarize of the case. Now you can see that to be able to complete assignment 2, case study number 2, you have got a certain amount of knowledge from previous week, plus some of the knowledge from finance management in this week already. But because of finance management is a big thing, it's a series of 3 weeks lecture, week 7, 8, 9. There are still a lot more to cover in lecture week 8 and 9, but our assignment case study 2 due at the end of week 10. So therefore, because you're going to be getting 3 weeks Easter break, right? I would suggest you to start to read case study number 2 now, right now, and then so this will provide you more time to go back to revisit those knowledge that you gain from week 3, 4, 5, 6 plus 7, and then I will extend the due date of the case study 2 from the end of week 10 to the end of week 11, right? I will put the new date onto the blackboard. Don't worry about that. And I will also send a message through the announcement of this new date. And the last assignment, case study comparative, which originally due on the 7th of June, will also be pushed back 1 week. 7th of June, which is Sunday, 7th of June. It will be pushed back to Sunday, the 14th of June. Doing this, the comparative case study of assignment 3, you already get all of the knowledge that you need from this course. Only one bit that you need to top into only the knowledge that you need to have to be able to complete last assignment is about the business planning and entrepreneurship and strategy content from week 11 and 12. So, but also you still need earlier knowledge from previous week as well. So pushing it back to 14 of June will provide you plenty of time. And because from after case study 2, you don't need to acquire any additional material for the assignment 3 because you already have case 1, case 2 to read and compare. So basically, when you start to look at case study number 2, you can start to think about what you're going to do in the assignment number 3 in parallel. And that is the end of week 7 lecture. And all of these change date, I will put detail onto onto the Blackboard. And during this time, if you have any question, you can post it on the discussion board. That will be the end of lecture week 7. Thank you very much for coming along. For participant, do you have any question?
No questions.
All right. So thank you very much, and have a reasonable, good Easter break. I know there are lots of things going on around us this time. And for BCA Singapore student, you won't be having this 2-week break because your semester start 2 weeks after us. But I'll be keep monitoring discussion board to help you to carry out learning, and I will also announce when the mark of the assignment case study 1 going to be released. Right. Thank you very much.
Okay. Thank you. Bye.